Okay, so I want to, sorry for a little delay, I'm passing around a file. I want to talk about and recap balancing a balance sheet. Obviously, yesterday it was very important to stress the construction of the balance sheet. I got it on that one, maybe it's better. And we kind of focused on the structure. Number one is the structure. Number one is the structure. Number two is the concept, right? It is very important to understand the idea that the balance sheet, assets, liabilities, and shareholders' equity is driven from how cash is spent or how cash is sourced. Cash flow drives the balance sheet. Right? And very important to understand the importance of that and how that keeps a model in balance. Every cash change should impact an asset, a liability, and shareholders' equity. So when building the balance sheet, we ask ourselves two questions for each line item. One, which cash flow statement line item drives this balance sheet line item? And two, in what direction? What direction does it move it? Right? And when we did that, we realized there was a pattern and formula that was followed. And the pattern and formula is first term is always the column from the year before in the balance sheet, plus or minus the cash flow change. And we further realized that for every asset, that term, that plus or minus term in the middle, is actually a minus. It's actually a minus because of the relationship between cash and an asset. If you see a cash flow that's positive, that means the asset's going down. So the balance sheet formula is always the year before minus that cash change. And the only exception to that is cash. Right? If cash is plus, cash will build cash, cash will increase, cash will increase. Okay. For liabilities, it's a plus inside. For liabilities and for shareholders' equity. Because the relationship between a cash and a liability is such that if cash is up, the liability is up, or if cash is down, the liability is down. Right? That's the idea, the concept. So if you understand that concept, the way we built it yesterday, and spend more time with it if you're still not familiar with it, you will understand that there are only 4 possible ways a balance sheet could ever be wrong. Number 1, there's a line item in the cash flow statement that you didn't link to the balance sheet. You left it out. And that's why going through building the balance sheet this way will help you build a more efficient, clean, and error-proof model. If you're going down and checking off the cash flow statement lines as you're using them, when you get to the bottom, if you've realized you left out cash flow statement line items and didn't link them to the balance sheet, that's a good reason why your model won't balance. Second problem. Maybe the line item maybe the cash statement line item is linked to the balance sheet, but it's accidentally been used twice. It's accidentally been used in 2 places. A balance sheet stays in balance when each and every cash statement line item links to the balance sheet once and only one time. So again, checking things off as you go down is a way to prove this. If you check off some other operating activities because you've used it in other current assets, and then you go down to other current liabilities and you might think, oh, I could use other operating activities, other, but then you realize you've already used other. That would avoid this problem of type 2. Number 3, maybe the cash flow statement line item is linked into the right balance sheet line item, but it's going the wrong way, or it's linking from the wrong column. This is where the structure and formula that I've explained to you would help avoid that problem. First term should always be F the year before. The middle term should always be plus, except for non-cash assets, then it's minus, and that'll help you avoid problem of type 3.
So that's wrong column or?
Wrong column, or it's going the wrong way. Fourth problem is maybe there's a totaling error in your cash flow statement or your balance sheet. You just have a mistake in your totals. That could also cause an imbalance. So when you're faced with a balance sheet, let's say you built it and you could swear that you put it together right and it still doesn't balance, there's a way with that concept in mind to try to solve an unbalanced balance sheet. Even if the model was built poorly, even if you're given a model and it's been built in many different ways, things are pulling from all different schedules, which I do not recommend, you can still print out the cash flow statement, print out the balance sheet, and do it this way. Okay? One is you want to create a differences column. So you want to identify, and I'll just show it to you. Let's say this model, this column doesn't balance. Okay. First of all, focus on the one column that doesn't balance. So in other words, forget all this, right? Get all this eliminated. Let's say 2013 doesn't balance. I mean, it does, but let's say it doesn't. Get all this eliminated, okay? And create a differences column. So in other words, we're just going to focus on the first column that does not balance, try to resolve that, and then hopefully once that's fixed, you just copy everything to the right, and the rest will fix itself. And you want to subtract, okay, all the way down. These differences, all the way down, these differences should match our cash flow. These are our cash flows, basically. So you want to go line by line, and you want to ask yourself the same two questions we asked ourselves when building the balance sheet, which is which cash flow statement line item should this be pulling into, and does the number match? Because if the number matches, it proves that we're pulling in the right number. If the number doesn't match, then we've either pulled the wrong column or we pulled a line item that we didn't intend to pull. So you want to match the number. And two, is it going the right way? So how do you know it's going the right way? Well, you just got to kind of step back and think about it and say, well, cash is going up, so I should have a positive cash flow, and is the cash flow really positive? You really got to step back and think about it. And then if you have a yes for both, very important, I can't stress how important it is that you check it off on the cash flow statement. A lot of people think, oh, I got this, and they're not checking it off, and they go to the bottom, and they still can't balance it, and then it's taking them an hour, 2 hours, and then they're emailing me the model. Because I realize that they're trying to be quick about it, and they're not checking things off, and I know what that means. They are overlooking a double counting item, or they're overlooking something that they're missing. Right? So you have to check things off. Check it off, go to the next one. Ask yourself the same two questions. Check it off, go to the next one. Do the same thing all the way to the bottom. And if you've gone down, it will be revealed which problem it is, whether it's type 1, 2, 3, 4, must reveal itself if you do it that way. Because if you've gone to the bottom and there's a line item that hasn't been checked off, then you know you've discovered a line item in the cash statement that has not been linked to the balance sheet. And if you've gone down and realized a line item has been checked off twice, then you know it's a line item in the cash statement that's been double counted. If you go to if as you're going down you're realizing the numbers don't match, or it's going the wrong way, then it's pulling from the wrong column, or the pluses and minuses are off. There could be a situation, though, where you actually did, in fact, check things off. Everything was checked off once and only one time, and the model still doesn't balance. Then you know that's got to be a totaling problem, and you got to check your totals. And an easy way to fix that is, well, if the historical is balanced, then the historical totals must have matched. So just take the historical formula and copy it to the right. That's it. It should take you no more than 30 minutes. I've never had a model that I could not unbalance. Yeah, really, we had a guy at a private equity firm. He was a senior guy, vice president. He called us up way back before he had the school because we would go in and teach the analysts. You know, we'd go in like, oh, well, can you really teach good model balancing things? I'm like, I think we can. And he goes, well, I want you to walk me through our private equity model to see what type of buyouts, how complex you can teach our analysts in a fair amount of time. So I went through and I said, oh, I notice your model isn't balancing. And he goes, no, it's off by 0.2. It's a rounding error. It's never a rounding error. And I said, well, it's never a rounding error. And he goes, trust me, you know, he worked at Credit Suisse, whatever. He had banking experience. He goes, I just came on an associate, but this model's been passed around for 3 or 4 years, and no one's ever been able to get it to balance. I said, well, we're going to do it. We're going to do it now. And it sounds like a story, but we literally, in about 15 minutes, found out what the problem was. And what the problem was, and I won't forget it because he was pretty surprised, is it was something like the total, because we went through the thing. I showed him how to do it, and everything checked out. So it was something like it was adding this $1.46. You know, it was adding like an assumption driver, which is very tough to catch. But this really works. This really works. It really works. So I had given you guys a model.
I don't have it.
I want to spend, try it on that flash stick, Cortez, maybe. Doesn't recognize. On that one either. You try, on both of them. Okay. I'll go up and see what's going on there. Chris, do you have it? Why don't you give your model to Chris? And then try to use this method to balance it Give it a shot. Start working on it now. It might take you 15 minutes. The first time it might take you the whole class. Let's see. I want to try to pace it with everybody, and I'm going to help you along too. But I want to first give you like a few 5 minutes to see if you're able to get started. If not, I'll help you get started, and at least I want to make sure everybody has it. So if you have it, pull it up. Let me just show you what it is. It is Walmart Broken version 2, and it doesn't balance. So it doesn't balance. So figure out, the goal is to figure out why it balances, why it doesn't balance, using the method. I mean, you can probably look at the model you have now and figure out why it doesn't balance, but that's not going to help you. This is going to be a big portion of the test. It's coming up. You're going to have to do this, and there's going to be 5 certain things that are wrong, and each of those 5 things is each of those different 1 through 4, and I can tell if you're going through the method appropriately depending on which ones you're finding. If you're not finding the one that was left out, I know you're not crossing things off as you go along, so the points are going to be scored that way. Okay, so we're looking at a balance sheet that's broken, and there are I believe 5 things wrong with it. And I want you to, I'm not going to give you the answer, but I want to at least kind of get you going, give you a good perspective as to how we should look at this. So if the balance sheet is broken, which it is, it's not balanced, the first thing you want to do is you want to make sure that at least one column balances, right? At least the historicals have to balance. If the historicals don't balance, and you have another problem, you have a bigger problem, you're inputting things wrong. Then we want to look at, just focus on the first year that doesn't balance. I would almost recommend just to delete everything else, not get distracted, and reserve that to create a column which I will call differences, where we will subtract. We'll subtract 1 year from the next. I don't care which way you're subtracting. Okay? And I'm going to copy this all the way down. Okay, so these changes should represent cash flows. So now the process is to go line by line, asking the same 2 questions we asked ourselves when building the balance sheet. 1, which cash flow statement line item drives this? And then just make sure the numbers match, which ensures that it's actually pulling from that line item. And then 2, is it going the right way? And this is where you want to step back and think, okay, well, if it's going down, right? So right now I say the cash is going down. So on the cash flow statement, it should be going down. So basically, what I'm trying to say is, what I should see in the cash flow statement is cash and cash equivalents going down by 3896.9. I know it should be going down because it's reducing here, and I know 3896.9 because that's how much it's changing. And if it does, I'm going to check it off or highlight it. So do I see a negative 3896.9 in the cash flow statement? Yes, I do. So this is correct. I'm going to highlight it, indicating it's been utilized, and I'm going to go to the next line item. Okay, receivables. Okay, so with that same thought process, how do you expect, or what do you see for receivables?
Look at the current year, subtract it from the prior year,
Mm-hmm. Bless you.
they should correlate.
Yes. So be more specific now. In which way? Okay. What should you see in the cash flow statement?
I should see in 2012, 2013,
Mm-hmm.
a decrease, so therefore there should be a decrease also in the sum difference.
Decrease in the asset down means?
If the asset goes down, it means, I'm sorry, it means cash should be increasing.
Increasing. By how much?
Approximately 146.
146.5. So I should see an increase of 146.5 in changes in accounts receivable. Good. That's the thought process. Okay, so let's see. What do I see? Yep, 146.5 increase. That's fine. Next one. Okay. Inventories. What do I see? What should I see?
You see a decrease in inventory.
Yep.
So we should also see that reflected in the cash flow statement.
Which way?
If the decrease in the cash flow statement, it should be also an increase in cash.
If it's decreasing here, it should increase in cash, so it's going down by 148.4. I just see plus 148.4 on the cash flow statement. Okay, it doesn't. What do I see? I see minus 148.4. What does that mean? Wrong direction. Okay. So if I go to the balance sheet, let's figure out why it's wrong. So this is taking F10 plus 14. You know, for every asset, it should be a minus. The signs are going the wrong way. This is a problem of type 3, wrong direction. We've identified that because we matched the direction. And you can see easily this is exactly where building the balance sheet this way would help ease in identifying these problems. It should be a minus. Okay. Now it looks good. This is going up by 148.4. I should see negative 148.4 in the cash flow statement. Continue. Take that as a clue as to how to go about figuring out what's wrong. Okay, so let's continue. So we're now at prepaid expenses, and we have prepaid expenses going up by 773.9. So what should we see in the cash flow statement to match? Opposite. We should see minus 773.9 in changes in prepaid expenses. And do we? We do. So that is looking good. Next, we have other current assets going up by 242. So what should we see? Maybe there's a combination of things in here adding up to minus 242. It looks like it's G8 and G38. Loss from discontinued operations, which is trivial. And what else do we say? G8 and what? G38. 242. There it is. The other financing activities. Okay, so that looks okay. It's minus 242, which brings it up by 242. Okay, next, we don't care about the total. Property, plant, and equipment is up by 56213. What should we see there?
We should see CapEx,
Mm-hmm.
depreciation,
Mm-hmm.
a couple of items like proceeds from
Yep.
disposed property and investment business.
And at what value should they net out to be?
I think that's accurate. That all of that was change of all of that was 561.
561, which direction?
Negative.
Negative. We should see negative 5621. So what I can do is, I don't know if you know, where I can hit CapEx, and if I hold down the control key while hitting other items, it'll total them for me. So if I hit CapEx, and then if I'm holding down the control key and then I select depreciation, so it's going to sum both of those on the bottom, 5621.3, negative, okay? So I can highlight both of those at the same time, and that's working. That's fine. We've used those line items. Goodwill isn't changing, so I'll just skip over it. Other assets and deferred charges is going up by 120. So what should I see? Minus 120. Where? So it's pulling from G11 and G26. Let's see if that makes sense. G11 is other operating activities, and 26 is other investing activities. Sounds like it makes sense. Negative 120 will make it go up by 120. So it looks okay. All right, so it looks like our assets are fine. Okay. What about liabilities? We go to liabilities, what do we see? So short-term debt's not changing. I'm going to skip over that. That's the way I think about it. You might have identified it, but if it's not changing, then I'm not going to consider it right now. Okay? Accounts payable is up by 701.2. Okay, so what should we see? Plus. Plus 701.2. And the liabilities, it's plus 701.2. Okay? Good? Let's continue. Accrued liabilities, up. $1425.7. Is that right? Good. Oops. Accrued taxes down 461.2. I should see negative 461.2, and I do. It's looking okay so far. Everything else 0, 0, 0, 0. Anything that's 0 not changing, I just leave out. Deferred taxes up 715.9. Which should we see? How does that match up? But what should be? And what is it?
Positive
What?
715.9.
What line item?
Deferred impact.
From where?
Oh, wait, this is coming from assets, so it should be liability? Oh, sorry.
Just where do you find it?
There should be in the depreciation chart.
Everything from the cash flow statement.
Okay. Ooh, sorry.
You said the same thing yesterday,
I know,
with
right?
the same line item. No. Yeah, just gets familiar with this way. What line item? From where? Operating activities. Yeah. There it is, up here. Okay. Next. That's it for the liabilities. Okay? Okay. Why don't you keep going? Okay, let's continue forward on this. Could be. Yep, good. Good. Okay, let's continue. So we're down shareholders' equity. Retained earnings. Retained earnings is driven from what? So far we've had two problems, right? There was the AR going the wrong way, and there was just the one problem maybe. Retained earnings. What drives it? And dividends.
And distributions.
Distributions. It's going up by 45275. So what should we see in the cash flow statement?
You see the same stuff.
Net income plus dividends. And you know, in Walmart they have the treasury stock in there, right? 45275. If you didn't catch it now, you would have caught it later. But this is right. There's no errors in here. 45275. Okay. Accumulated other comprehensive loss is up by 52967. They got a lot of stuff going on in there. Okay. They got G38, G40, and G33. Okay. So G38, double counting. It's the first problem. This is why you have to be checking these things off. So, what do? What's the problem? What do you think? What do you mean? What's wrong here? So what do? How do we solve it? Choose one. Yeah. Which one do you want to choose?
I chose the liabilities.
Where was it before? It was in liabilities? I think it was in assets.
Oh yeah, it was an asset. Yeah, I left it out.
You left it in assets?
Yeah.
And took it out here? Okay, I mean, in the actual model, you put it down there, but you know what? As long as you identified it, you could do either way. Let's take it out. Let's stick with that. It's fine, as long as it's balancing. Good. Still, let's continue. G40 and G33. So G40 is effective exchange rate on cash, so that's good. And then G33, dividends paid. So it's double counting the dividends paid. Okay, double counting two things. Just eliminate it. Okay, got it? Double counted two items. Okay with that? Nothing else changing, nothing else changing. Okay, still not balancing. We went through this whole thing. What could that mean? That could mean there's only two other problems. Summation error, or what else? Could mean another problem as well. We tried, we proved wrong direction. What else? Missing line item in the cash flow statement. Is there anything in the cash statement we didn't use? Yeah, short-term borrowings. We didn't use. That's it. There's a line item in the cash flow statement that was not linked into the balance sheet. If I go to short-term debt, I notice it stayed flat. But there's a line item that's showing that they paid down the short-term debt. It wasn't linked up. There's one problem. So we got to link this up. So right now we have short-term debt equals to the year before. We got to do equals to the year before plus change in short-term debt. Okay, so we've identified that. Now I'm confident we used every single line item. It still doesn't balance. Every single line item has been used. Now it must be the problem. The analyst. That's right. That's exactly right. Now what happens? Now what could it be?
Well, you can do,
Summation.
yeah.
So let's check the totals.
You can do a difference of the assets and shareholders' equity and liability and see if there's a difference of 4241.
Don't even have to bother. We can just check the totals. Change in operating working capital looks good. Cash flow looks good. Investing activities looks okay. Financing activities looks okay. Cash and cash equivalents. What? It's missing the effective change in cash and cash equivalents. It's missing that. So we go to the balance sheet and now it balances. Okay? Now it balances. We have to add the effect of exchange rate on cash.